Live from the NASDAQ market site, this is Fast Money. We'll get to all the stories in just a moment. Got to first get to the action in the Gap guy, gapping lower by about 15%. It's all cute. In the guidance.
Lower.
You thought of that
no pun intended.
It planned it out.
Played on
well, if you watch the halftime report, we had Roxanne Meyer, who I used to work to. I pointed that out
to you,
right?
You
and
did.
She said, she wasn't a big fan of the Gap. Good for you, Roxy, because you nailed this one. The quarter wasn't bad. The guidance, though, was atrocious. I think they guided full year to $1.45. The street was at like $1.90. Not good. Plus, they had a pretty big inventory build by my calculations, up almost 11.7% year over year. So here you have Gap now trading around $20, give or take. It feels as though any shorts that are in there are going to lean on it. Any shorts that weren't in will lean even more. So look for this stock to probably trade down the low 19 area tomorrow. Maybe then you can buy it because valuation should be a little bit better.
Is anyone else concerned about the whole retail space?
I am, Steve.
Okay, you first. You first. I think at this point, retail is definitely overbought. I think the whole idea about gas coming in, over-factored in at this point. We're going into summer months. We're going to the calendar. Not great historically for retail stocks. I'd be selling them.
Really?
Well, I want to pick on him first.
All right,
seem to agree with me.
Well, guidance, if that was the problem at Gap, it was the problem at Aeropostale. I mean, that is what people said. They were guided down 48%. And I agree with you, though. I mean, if you've listened to every CEO, he's pointed out that currently his business is fine, but that he saw strains from higher gas prices. So, I mean, Target told us this, and I realize that Target's customer may not be the Gap's customer, but it's definitely more the Gap's customer than it is Walmart's customer. And so, I think we're in a place where the consumer is a little stretched. I think the consumer is very cautious. And if you look at the payroll and the jobless claims numbers, they don't tell you that the consumer is in a much better place, at least in absolute job terms.
I'm sorry, one last thing. Abercrombie, we saw that huge run up. We've been all over it. But what have people been buying it for? The international growth story. So if you're at all worried about Europe, you want to be selling Abercrombie at around $75. So that just adds to it. I think we factored in a lot of the global growth and a lot of these names that are international plays, and I think it's overdone.
Tim, yesterday or the day before, you were saying that the Gap had a lot of international stores, and that was why you would want to be, it's like a McDonald's in that respect. Do you still stick by that, given the other headwinds that it's facing right now?
It's a small part of their business. It's an exciting, calling it a tailwind, no, but it's an exciting upside to their business. Again, I said they're currently in about 380 stores globally. They're going to have 180 franchise stores by 2015. That's a very positive story, but Gap's sales are still predominantly U.S. So it's the same thing when people talk about RIM and get excited that they're going to be in China selling their BlackBerry. This is a U.S. company, at least a U.S.-focused North American business. So is the Gap.
I feel like for the retailers, it's not, sort of all risk on or risk off. It's getting more differentiated than that. And if you have a good strategy and good merchandise and you're executing, then you're going to do fine. Look at Macy's.
Right.
Macy's has been stellar. Saks Fifth Avenue on the high end. They're raising price, they're changing their mix a little more upscale. Saks doing
Well, what happened
well.
to Macy's today, though? I mean, they got crunched.
No, Macy's was up today.
I'm sorry, I'm looking at Sears. My bad. So, I mean, is the point, though, that some of these stocks that have had a great run, if they're still at a decent valuation, you're okay with them?
Yes, it's exactly. Macy's is at a decent valuation, even here, even after the run.
Macy's, by the way, fresh 52-week high in today's session. The conference call on the Gap just getting underway, so let's bring in Brian Sazzi of Wall Street Strategies. He's a retail analyst getting ready to get on the conference call. Brian, what's the first question you will ask management?
First question is here, is this a kitchen sink type guidance? I know they lowered it by about 40 cents, but is this as bad as it's going to get? And I'm not too sure. When you see a call out for inventory up maybe 15% in the second quarter, it's quite worrying. That raises the markdown risk. Ultimately, what is going wrong with this company? One, they're trying to pitch the international growth story to investors, but it's just not working. Other companies are really taking market share from them. Also, there's no pricing power in this business. So when you have unit costs per item going up 20% and you operate a chain such as Old Navy and you're competing on price selling socks and T-shirts, it's going to be very difficult out there.
So, Brian, who's the retailer that you like, not necessarily based on what Gap just said, but just in general in terms of how they've been operating?
Well, Guy, to Karen's point, you should be looking for some differentiation here. There are winners starting to emerge from the losers. A couple names would be Hot Topic, Zoomies, and Wet Seal. Now, I do think the RLX is starting to break down a little bit here. Ironically, which is similar to what happened in 2010 after the batch of first quarter earnings reports, and I think the fundamentals in retail are a lot worse now than they compared in 2010. But you look for companies with differentiation that actually had some positive things to say on the conference call and didn't lower the boom completely on second quarter earnings guidance.
In terms of the Gap, getting back to the Gap, what is the answer in your view? Is there one? Is there something that management can do to lift this business? Does the Gap story get so bad at this point that maybe it looks like some sort of target by a private equity firm that could turn it around?
It boils down to product. Get the product in the store at the right time, and there will be success. But the CEO who's currently in charge, he was heralded because he's done some fine work on cutting unproductive stores. But at the end of the day, he's not a merchant, and he's not. I don't think they have the creative talent right now to get everything right in terms of merchandise, because merchandise is what drives this business, and they're not doing it correctly.
All right, Brian, thanks a lot for phoning in. Appreciate it. Brian Sazzi, Wall Street Strategies. So, Grasso, you still think it's either all on or all off in retail?
Well, at this point, I think retail has had such an incredible run over the last couple of months that I would say that all the positive news is probably baked into it at this point. So I would be taking the profits there and putting them into some of the other beaten up things. But I believe the market is coming in as a whole. So I would err on the side of moving to the sidelines just for at least the next month or so, just to see where the chips lie. But retail, definitely for me, I think it's overdone. And you mentioned private equity. I think the reason why Gap stores held in was because everyone was afraid of that bid. And I don't think it's come.
All right, let's move on here, talk about the overall markets today. And what popped out, at least to me and some of the producers back in old Englewood Cliffs, is that the old quote-unquote boring safety stocks actually did pretty well today and have been doing pretty well so far this year. Take a look at the outperformance here. Healthcare, consumer staples, utilities versus the S&P 500. All of those sort of safe sectors have been doing well. No coincidence, perhaps. They also oftentimes pay a pretty decent dividend that can compete with the yield on the 10-year bond.
Yeah, and two names that we've talked about forever now, I think, on this show, and I think you can continue to own, I think, regardless of your broader view in the market, are McDonald's, MCD, obviously, and Yum Brands. I think both made all-time highs today. Both, I think, you get a decent dividend, not a fantastic dividend, but operationally, you can't really knock any holes in these guys. McDonald's just reported their comps for the month. Asia Pacific was great. Even Europe were fantastic as well. So Jim Skinner seems to be doing everything right at McDonald's. Yum as well seems to be doing everything right. Those are two names that I think good tape, bad tape, benign tape do well.
I love both those names, but Yum now approaching 20 times earnings. We're selling stock into it. It's been a great run, but the risk reward has changed.
You have used the options market before, Karen. So was there ever a point in time where you thought, you know what, I'll do a stock replacement strategy instead?
I haven't. I should have, actually. Instead of selling any, it would have been better at this point. But there wasn't a ton of volatility in there, but I should have. Good suggestion there, emissary.
Another name that didn't quite fall into those categories, but industrials also did very well today, and a good old-fashioned favorite name, good old GE, had a big name. And this is a name that also looks very well positioned for global growth. They won huge contracts for turbines in Brazil today. They outflanked a lot of the legacy players, including Latin American companies that have been there forever. Brazil plans to be 30% at least of where GE sells all of their turbines in Latin America. And this is a very exciting story. So when you're looking at the industrial sector, which people think cyclically could be a little stretched here, there are some names that have exposure to the global cyclical story, which I don't think is dead.
I ran into Dominion Resources, letter D, coming off the tragedy in Japan. Right there, you're looking for yield. Now, I don't really chase yield because I'm afraid of loss of capital, but I've seen money come into the utility space. I've seen it stay there. I haven't seen it move away. It's still one of the ETFs that are strong, but I like this single stock, Dominion Resources.
All right, let's move on and talk about the big story of today, and that was the IPO of LinkedIn surging 110% in its market debut. The move means that the professional social networking company's market cap was, well, at least one point in the day, bigger than 46% of the stocks in the S&P 500.
Sick.
Karen was all over. She was buying on the open.
Oh, yeah.
I'm sure
Both
she was.
hands.
Hand over fist.
Oh, yeah.
Hand over fist.
Yeah.
But you did some interesting sort of back-of-the-envelope calculations.
Well, just on a revenue, I mean, if Google had traded anything close to the revenue multiple that they get, I think it would be something like $23,000 a share, which was meaningful appreciation from here.
But it's crazy. So 25 times revenues that if they duplicate the first quarter over the next three quarters.
Right, revenue.
No, that's what it was.
They have
to.
to
Priced.
Exactly.
Not where it
was priced.
Right.
Not even where it went to. Good
Yeah.
point. So now
Where
it's
it
about
went to was
75 times the revenues that it had in the first quarter that needs to complete over the next three quarters. So look, it's been a fantastic boom to other players in the sector. So I mean that's really the software over the internet, so supposedly business that CRM and some of these other guys are in got a huge boost today. This was really the story. I think it was the knock-on effect. effect.
I think Guy brought up the most important point of the day, the pricing of this. Now, I don't want to point any fingers, but the mechanism that we're using to price these things, this is what creates the bubble. The next IPO that comes out that's even close to this type of a sector, people are going to trip over themselves to try and get because they think it's going to be the next LinkedIn. So I think we really have to look at the pricing mechanism and understand what the ramifications are.
This argument has been made over and over and over again.
But
on Wall
I mean, it was
Street, right?
$2,600, not $26,000. Which is still meaningful. It's 500% up from here.
Yeah,
it's always made. The argument's always made, but it doesn't mean that we should forget about it. And it's the same thing with an analyst. Analysts would always like to put a lower price target than where they think it's going to go out because they'd rather be wrong on that side than the other side. They'd rather err on the side of caution. And I think at this point they're way too conservative with their pricing mechanism.
Yeah, I mean, you want the public to have confidence in the system. Typically, it's something prices, maybe it trades up 10 to 15%. That's reasonable. I think everybody's happy. The bankers, the company that went public, everybody. But for something to double on a day today, I think you watch the news tonight and the public sees this and says the only people making money on these things are those fat cat guys on Wall Street. It's not true, but it appears to be true. And I think optically it doesn't look good.
Wouldn't the bankers be really bummed out that actually a stock that they brought for around $50 is closed at 122, wherever it closed?
Plus you got a lot of
did they not
no
price
matter
this?
how much shares you got, you feel like you were. I didn't get. We didn't. It's
but
not
did they misjudge demand that badly because they didn't price this thing well? I mean, if in fact, I mean, nobody leaves that much on the table. I mean, it's nice to leave a little on the table.
Didn't it happen with Dang Dang when Dang Dang was
Dang, don't Dang Dang. Yes. In fact, it did.
It did. It happens over and over.
It happened with Yahoo, and it happened back in the day. But I guess you expect to see that a little bit
Where's Dang
on the
Dang
NASDAQ today.
In a zoo somewhere.
Kitty dang dang. It's not.
It's in the Washington, D.C. Zoo. All right,
That's
now
a
let's
bad
move
joke,
on.
but it's funny. We should play that game again soon. I know you want to move
IPO
on.
or Panda. Yeah, no, we got to move on and talk real business here. We wanted to hit on CRM, Salesforce.com. We were mentioning it earlier in the conversation because its business model is similar to that of LinkedIn's in that it is based on subscriptions for its software. So that stock is popping on the release of its earnings. It beat expectations by a penny X items. So it does look like a very good quarter here.
Guided high for the full year. Revenues were $504 million. This year was about $482. Big short interest in this name, I think about 11%. They're obviously all getting squeezed now. But then, we want to talk about valuations. Here's the stock that's moving in about 80 times next year's expected earnings. So you wonder if is the revenue growth there, is the EPS growth there, does it justify this? My sense is no, but it doesn't matter because these are one of those names, and not unlike Netflix, that the momentum is behind. Very difficult to trade it from the short side, but I can't advocate going and buying it right now either. So one of those names, I think here at 146 or so, you stay away from.
By the way, Dang down 40% from its December 8th IPO. So again, a company that
So is it basically at its IPO price at this point?
It's at right now. It is slightly. It's below.
It's below.
Yeah.
All right. Well, that's interesting there. All right. Let's go to JJ Kinahan. He's working the prop desk. And JJ, you noticed some unusual activity in CRM.
Yeah. First of all, Melissa, the options market missed this one a little bit in the fact that they were only pricing at about $9.50 on the move. So they were off a little bit on that one. But what was interesting is we saw call buyers. The stock closed at 135. We saw 140 call buyers. We saw 145 call buyers in June and in May. So the people who were playing were a bit bullish on this stock going into it, which did make sense, and so many of the stocks have beaten or at least met the earnings estimates this year. So there are a lot of happy folks in this stock tonight who were playing the option speculatively for this up move.
Shepard Smith here. Thanks for watching CNBC on YouTube.